Live. Okay, we're live. Okay, good evening, everyone. Um, we're live. Today I have a special guest, Andrei Yakubovich, right? Did I pronounce that right?
Yes, yes, you did, Mario.
Yeah, and
Jakubovich. Maybe
Yakubovich, Ya-
Jakubovich.
Jakubovich.
Yeah.
And I met Andre on LinkedIn, and he follows the channel, and he's made some interesting posts about various things, especially money supply, and that's why I have him on today to talk about that. Andre, usually as I said earlier, I start a little earlier and say hello to everyone. So we're just going to say hello to everyone here. We've got Rumpelstiltskin. He's actually based in Japan. And for him, it's easier today because we went back an hour. I don't think in Japan they've changed the time yet. We've got Olivier Leroy. He's from Paris. He's here. We got Belly Dance Arabia. Who else? Grow Mechanic is here. Androrama. We do have quite a few people from Brazil, and Andre is from Brazil. So, Andre, maybe you could
Yeah.
tell the viewers, a little bit about yourself before we start and how we came to get in contact.
Well, I started a banking career back in the 80s at Citibank, Rio de Janeiro, where I developed a credit background, became a relationship officer for multinational companies at Citibank Rio. I spent 4 years there. Then I went for an MBA program in the United States, after which I joined Citibank New York. And I spent 3 years at Citibank New York. Then I moved to BNP New York, and where I spent 9 years in investment banking, treasury operations, all sorts of high-end banking activities. I moved down to Sao Paulo and started my own hedge fund. I spent my hedge fund was warehoused at one time at GP Investimentos and so on and so forth. At one point in Brazil, we had low interest rates, and after spending my entire life in the financial industry, I thought the real economy was about to take off in Brazil. So I started investing my own funds together with some investors in some hydropower plants in Brazil. These are they're ready to launch. We're working on financial solutions for building them out, and I still, I'm still involved in understanding financial markets. Things are changing fast. As of recently, my background in energy, together with my background in finance, brought me to understand a lot more about money. I watch your videos as a great source of understanding the base layer of money because Mario, money and energy, they go hand in hand. You see, your time and your energy is all you got. If someone can just press a button, print money, debase your purchasing power, what they're doing is they're stealing your time and your money. And it's funny because I'd say I'd had quite a successful career in banking, but I didn't know, I did not understand about money, which is crazy. But anyways, here we are. I'm
Yeah,
very happy to be here.
yeah, and I worked for Citibank as well back in the 90s, and then I worked in the futures department in London,
Mhm.
and then we were taken over by ABN AMRO. I worked there for 8 years, but like you said, I didn't until I bought some gold in 2002 and started looking at things. I just took money for granted. I didn't like understand it either, like you
Mhm.
said.
Yeah.
Someone is asking the name of the hydro projects that you have.
Uh, these are two small hydropower plants in the state of Mato Grosso.
Yeah.
These are government concessions. They are open for dispute. I won the dispute under a competitive process. I have the exploitation rights for 30 years and plus 30. Uh, these are hard assets that generate energy. They're less cyclical. They tend to protect you against inflation. Right now in Brazil, there's an ongoing rearrangement of the power grid. Brazil has been plagued by renewables and all sorts of wrong power matrix decisions, just like you have in Europe. But at one point, they will need to make ends meet. Energy is a national security imperative. And I think we're very close here in Brazil to be able to finally launch the construction phase of these projects.
That's good. And I would say that if people want to know more, they can try to connect with you on LinkedIn, I
Absolutely.
guess. Yeah,
Yeah.
I'm gonna share again the name so people
Mhm.
can see who it is. There he is. He's on LinkedIn. Andre Luis Jakubovic. So there you go. And yeah, it's interesting because are you originally from São Paulo?
No, I'm from Rio, Mario.
Oh,
I
Rio
went
as
to New
well,
York. Yeah, I
because
went to
I'm
New York.
originally from Rio.
Yeah, I
Yeah,
know that. I
yeah,
know that. And yeah, I came back from New York to São Paulo
yeah.
back in the 90s, and I've been here ever since in
I
São Paulo.
see. I see. So yeah, we still got 5 minutes. Let's see if people, if anyone has some questions before we're gonna start looking. First today, we're gonna talk about MMT, and this is one of the topics that you think is, that you want to talk about. I've got all the list here. And we're gonna talk about M2, money supply velocity. And yeah, so let's see. Why are bars cheaper than coins? Because just going to answer that question because the coins are, they're more detailed, they're minted, someone has to design them. Bars are just simpler. You just put it into a mold. That's why they're more expensive. And gold coins, usually when they're circulating coins, you have to put an alloy to make it harder, like copper. So it's a more, and the bars for bullion bars, they're usually 999. So I think that's why they're more expensive. They have a premium. Any view? How is the gold situation in Brazil? Is it easy to get gold and silver physical?
Mm, I'd say if you look hard enough, you will find. I'm not very familiar. I don't think gold is a thing here in Brazil. The young generation here in Brazil, Mario, they're into crypto. The situation here in Brazil is becoming increasingly clear that we will engage into some form of financial repression. We expect negative real rates, maybe higher inflation than we would like. That might push the exchange rate up, and people are taking hold of that. I remember a time back in the day, Mary, in high inflation days, gold was a real big thing here in Brazil because you could hold it, keep it to yourself, and it was dollarized. So at one point here in Brazil, gold was a big deal for protection against inflation. Since the Real Plan, we've had some ups and downs in inflation, but for the most part, Mario, here in Brazil, we've had, maybe for the wrong reasons, real positive interest rates. Brazil cannot afford negative rates for too long.
Yeah.
So for the most part, we've always had real interest rates because if not, everything else breaks down. So
Yeah.
gold, I would say, because of that reason, it's not a big deal here in Brazil. Yeah,
Yeah. And I think a
am I
lot of
making sense?
people, well, sorry to interrupt, but
No.
from what I remember as well is people think of the dollar as gold almost in Brazil. They, as a protection. But you're right, the real is going to be, I think, 30 years old next year. So, and it's still around. So it survived quite a bit because before the real, we had like quite a few currencies.
Mhm.
Yeah. So, okay, so let's start then with the topic of MMT. You told me earlier that the MMT people thought they were in control and that bond prices would go up forever. And I never believed that. So can you talk a little bit about that and let me know which charts you want me to bring up as well?
Well, I was looking for one particular chart, Mario, that I couldn't find, but I'll put it in simple terms.
Yeah.
If you think from Volcker, fast forward to today, we've had a tremendous bull market in bonds. So it sets in the notion that bond prices go up forever. So it helps them print the money and keep money velocity in check. Because if you have that kind of a bull market in bonds, uh, you tend to money tends to stay where it is in bonds, so it doesn't go into the real economy. Money velocity doesn't take off, and you start getting this feeling that money printing is not a problem. If I learned from your channel, by the way, that the US dollar and the Swiss franc, they had a 7% per annum inflation rate on average throughout all this time. That is the least inflation rate amongst every other fiat currency. So if you think about the fact that the dollar has had a very low inflation rate until recently, and you add to the fact that bonds have been in a bull market until the very end of this image that you just posted.
Yeah, so
Uh,
that's when Volcker let the short-term rates go to 20 and the
exactly. So
10-year yield topped at 15.6, I think. And that,
exactly. So what I'm trying to say in simple terms is the dollar had one of the lowest inflation rates within all other fiat currencies, together with the Swiss franc. You had a very long bull market in bonds. So money velocity was kept in check until recently. I hope I answered that question.
yeah, let me bring up the chart of that's the chart that you posted on LinkedIn, and I think it was Clive, Clive
Mm-hmm.
Thompson.
Yeah.
He retweeted that, and I thought it was really interesting, and that's why I got in touch with you. So
Mm-hmm.
let's bring it up. I'm going to share it. Maybe you could maybe explain to the viewers how money velocity is calculated because I remember as well when money velocity was really low uh, up until a couple of years ago, and now starting to rise. And a lot of people were saying, "Oh, we're never going to have inflation because money velocity is almost down to one."
Well, I'm going to, there's one image I shared with you, Mario, which shows the P&L for the US Fed.
Oh yeah, I've got that.
But
This
just,
one.
yeah, yeah. I'm going to talk about this image to try and explain money velocity. I'm not a technician about monetary plumbing and stuff, but I'll give you a good idea. Until recently, the U.S. Fed would have profits. It would transfer to the U.S. Treasury. Then rates went up abruptly. They had long duration bonds in their portfolio, and now they're up to, I would say, 160 billion in accumulated losses so far. These losses are not booked. These losses will be reversed over time. Thus, before the Fed can once again send money to the Treasury. So these losses aren't accounted for. They have to be reversed, and then, and only then, the Treasury will start again earning income from the Fed. Why is this important about money velocity? What happens is they printed too much money, and the amount of money that the central bank is paying to banks under the reverse repo facility is $700 million a day. And as of recently, only last month, it went under $700 million a day, because now US treasuries are issuing a big number of treasury bills, and they're emptying up the reverse repo facility. The reason I brought up this image to talk about money velocity is because as long as money is flowing in between the Fed and the US Treasury, and hence not going into the real economy, there's no inflation pressure. But once they printed too much money, especially since COVID, and price pressures started to emerge, people took notice and they started rushing to spend because prices going higher. And if you go back to the prior image of money velocity, you can see from the graph that all of a sudden, the blue line becomes positive and rising. And that's basically how I would describe money velocity. Is money leaving the bond markets, money leaving the interbank market, and going into the real economy for whatever reason. But for the most part, we know is because people fear prices are going higher, so they want to buy it before it's unaffordable. That's, I think, my best way to put it.
Yeah, and that's despite the M2 money supply going down, shrinking.
Well, that goes back to the other graph.
Yeah.
They raised the rates.
Yeah.
The damage in the U.S. Fed is visible. The negative numbers in the U.S. Fed balance sheet is visible because they've raised rates. So what they're doing to try and compensate for this excessive spending is by raising rates, taking money out of circulation so people can rush to buy anything, and keeping that money with U.S. treasuries and while they drain the reverse repo facility. This reverse repo facility is expected to run out within the next 3 months. Then they will have to resort to taking even more money from the economy to buy these treasury bills, which are increasingly in larger numbers. And that's, we're not too far away from a big credit squeeze in the real economy. You see, the U.S. Treasury has been issuing a lot of bonds. There's not enough demand for it, especially from foreign buyers. But there was still a lot of money sitting in the reverse repo facility. It's running out fast. It's down to about 1 trillion, but at the pace this is going, the reverse repo facility will be gone in about 3 months, and then they're going to have to suck money from somewhere else, basically from the real economy. There's going to be less credit for investments, for working capital, for building new factories, opening new businesses, and that's when things might become problematic, not just for the real economy, but especially within the financial industry.
Yeah, and it's interesting that you said the Fed's trying to keep in the Treasury the all the money out of the real economy, but from what you showed me about the money velocity, it seems like they're not succeeding because maybe people have twigged on that they need to spend before
Uh,
things. That seems to be a weird.
very no, very well said, Mario. Here's the problem. Why is it? Why does it seem they're not succeeding? The problem with the United States today, Mario, which is quite alarming in my opinion, is that the U.S. Fed is trying to suck up liquidity by raising rates, but the U.S. Treasury is running a $1.7 trillion deficit, issuing a ton of bonds, and debt servicing costs are up to $1 trillion almost. Debt servicing
I saw
costs
that
already,
981 billion, the latest figure.
it's already over the military budget. So think about it this way, Mario. You have one man at the at the central bank raising rates, but by doing so, there's a lot of money in the form of interest expense going into the economy. And the federal government is spending yet another couple of trillion in deficits. So if you're running an economy where there's $3 trillion combined, every time the Fed raises rates, there's more consumption, there's more inflation. So there's what's what I call a doom loop.
Yeah.
It's worse than most people think.
Do you
So
think
people,
eventually we could see a trigger, like because von Mises, he says that there's you can't tell when it happens, but people suddenly realize that inflation is never going to stop, and you go into almost hyperinflation.
I think this is a real possibility, and I will tell you how this is going to happen, and there's nothing the Fed can do about it. The real problem, and I think we're getting close to it, Mario, is I don't, look, I posted today something, Mario, on my LinkedIn account that says uh, it's not about inflation, it's not about GDP, it's not about jobs, it's about counterparty risk. If you look backwards, not ever did the Fed pivot and started printing heavily without a counterparty risk event. It is what it is. So what I started to look into right now, after so many months of Fed hikes, and I started looking into the banks, and there are many points of failure in the financial system because they're sucking up the liquidity from the system. So there's not enough credit. There's what we call the crowding out effect. We learned that here in Brazil faster than most. So this crowding out effect is basically taking the oxygen out of the real economy. This leads to a bigger number of defaults for banks. This also leads to lagged effects of these hikes, where I can imagine quite a few points of failure. I would say collateralized loan obligations. It's a big market. They started with that when back in the Bill Clinton days, when bonds were being redeemed. The banking system needed collateral. They securitized all these car loans, all sorts of loans, and now that's a huge market. And we already are seeing some cracks in this market. We've had the SBB event back in March, May. And now look where we are right now in November. And I think we're going lower. If you look at the banks, they reported as of recently, I think they're running out of cosmetics in their balance sheet. If you look at the banks, CDS, I think the markets are smelling the rat.
So this is could you explain to the viewers what this is?
This is credit default swaps as of this week.
Yeah. So
For
that's the cost of insuring against default. That
yeah,
is, and it's rising. So that's a bad thing.
yeah. What's noteworthy about this chart is the spikes, the general spikes. And like I said, the biggest problem for the U.S. Fed is that regardless inflation still running hot, regardless of structurally uh, higher food and energy, the Fed might be forced into a pivot to save some uh, some bank or to reinstall liquidity within the financial system. What I see happening here is that we might wake up one morning where liquidity dries up. Uh, it's not gonna be pre-announced, and the Fed might be forced to pivot. And I think this is the only point where the Fed will act. It will not. They will not act unless unless to save the banks. Let's
Yeah.
put it
So
kindly.
I guess basically that if the one of the too big to fails gets into trouble, like Bank of America, then they'll have to come and pivot because if Bank of America goes, all the other ones will go, right?
Well, and if I may say, I didn't want to say this here,
Yeah.
but if you look at Bank of America's balance sheet and if you look at it, looking within the details, it's terrible. Bank of America is in terrible shape. I'd say Citibank is also in terrible shape. Wells Fargo, terrible shape. I think the Bank of America is maybe Bank and Citi are in pretty bad shape. And when and if will they be when a bailout will be necessary, not if. It's anyone's guess, Mario. We can wake up one morning and things happened.
Yeah.
It's not going to be announced. One important thing, which I think your viewers will be very interested. You mentioned about hyperinflation. You see, think about it this way. There's a real risk of higher oil prices due to the tensions in the Middle East. I think these risks are way understated. I don't think markets are reactive, proactive towards that. They're going to react as usual. That being said, everything runs on energy. So inflation is going to be a lot more stubborn than one might think as we see oil prices going higher. That being said, the amount of leverage in the system, if you see a bank failure or some kind of need for the Fed to intervene, he will have to do that. The Fed will have to do that in the face of high inflation uh, and wars potentially, which is almost certain to lead to runaway prices.
This is
And go
sorry.
ahead.
Go ahead. No, no, go ahead. Continue. It's fine.
No, I think this is something that has to do with collateralized loan
Yeah, you were
obligations,
talking about that earlier, and this
which
guy.
is a yes,
Yeah,
a very important point of failure
yeah,
that might jump out of nowhere all of a sudden.
yeah,
I don't think I should be warning people about from where the monster is going to come from the trees, but that's one of them for sure.
yeah.
Going back to what I was saying, Mario, think about it as follows. Uh, the entire financial system resides in the US bond market. Okay, that's the base layer for the entire financial system. Your viewers are well aware that under the fiat currency system, everything is backed by debt, not by hard assets. So let that think about it for a second. If the Fed is forced to pivot to protect the banks in the face of high oil prices and still running fast inflation, uh, the bond markets are very likely are going to go haywire.
Some people
That means
expect that they think if the Fed pivots, though, that they're going to buy bonds and the rates are going to go back down, but maybe in the short end, but not the longer end.
There's an interesting point you mentioned, and I will get to it in a second. About being bullish on bonds under the scenario you just described, Mario, for people to accept to be debased for as far as the eye can see, say that's a good one. That's, to me, the writing's on the wall right there,
Yeah,
Mario.
it's like reverse
But
indicator.
this means they're desperate. But what I'm trying to say is, for you to have a bond rally after looking at the numbers, the fiscal situation the U.S. Treasury is in today, you must be really scared, not just scared. If you do you understand what I'm getting at? The flight to quality to bonds that are mathematically certainly to fail has to be extremely under extremely scary conditions. I was going to say, outside a forced flight to quality into bonds, as the markets go haywire, if the Fed starts printing, and keeping in mind that the entire financial system is under the layer of the US bond market, they most definitely will have to do some kind of repression to keep things under control. I can tell you they could be doing yield curve control by buying their own bonds, like the Bank of Japan. They could be creating some sort of mechanism to force a perpetual demand for U.S. bonds. They can apply CBDCs if they can get it approved, so to force people to hold treasury bonds, or they can go to war and force people into buying war bonds and deleverage the whole bond market through a war, like they did back in World War II.
Yeah,
World War II,
even in World War One, they had peace bonds, and a lot of people bought them, and then in the 20s they collapsed.
there you go. So it's no coincidence what's going on in the Ukraine, in the Middle East, and in Taiwan at this moment. For those who are in charge of the money printers, a war would come in very handy right now, Mario. And with all these bad options that they have at their disposals to keep the bond markets in check, your message to your investors today has never been more important. Like I was saying in the beginning of our conversation, money printing hasn't been a big deal because of the long bull run in bonds, where this money was just making capital gains and interest gains on the bond markets for so long. And what they did basically was a big mistake when they thought that they could print into eternity when COVID came. What
Yeah.
they thought was, since markets are going to be locked down on a global scale, we can print all the money we want because there won't be any inflation, because this money is going to remain parked in the financial system. But once the lockdowns were over, here we are. 40% of all dollars were printed during COVID. And now, I hate to say it, there's hell to pay.
Yeah, and they took the Fed, the Bank of England, ECB, they dragged their feet. And I noticed that Brazil and Mexico, they started raising rates really quickly, which is unusual because
Mhm.
it's the other way around. I'm not being like a not trying to be offensive, but the banana republics, they usually don't the Europe and the US acted like that. And this is a chart of the price of gold in yen. And yen, the Japanese, they've been doing so much money printing to keep their bond markets from collapsing. And look at and I think that's what's going to happen to gold and dollars as well if they have to do this. They might keep the 10-year yield below 4% or 3, but then gold will be a lot higher. Is that the way you see it too? Or
As of recently, I've seen quite a few graphs, not only against the yen, but against many other currencies. Gold is on an all-time high against a bunch of them, if not most of them.
yeah.
Uh, that being said, Mario, if I were to tell you specifically about the yen, I recently posted something to say about Japan, basically to highlight the fact that what will drive Japanese monetary policy is not inflation. They have too high a debt to GDP. They already own half of the Japanese bond market. They are sitting on $1 trillion in US treasuries. So uh, I came to the conclusion, Mario, that the Japanese yen is the least worrisome to me because they can manage the yield market, their bond market, and their FX rate. If anything, by resorting to their $1 trillion war chest in U.S. Treasury bonds. That being said, Mario, hold your breath. If the Fed needs to pivot, and we're talking pivot to the tune of trillions of dollars, I mean, forget about a weight. Well, in no way it was $700 billion, Mario. We're talking now something to the tune of trillions of dollars. If they have to do that, the yen is going to have a flight to quality. The yen might go down to 80 when and if the Fed starts printing.
Yeah, that was the low in the dollar in 2013, wasn't it? When they started Abenomics, the dollar got down to
Yeah,
80.
if you look at exactly. If you look at the yen graph, it went really down, then started going back up again. And if the Fed has to print, I guess the yen is going to appreciate quite a bit as a flight to quality, Mary.
That's interesting, that's because yeah, no,
I think $1 trillion in foreign reserves, U.S. Treasuries held by the Bank of Japan,
yeah,
it buys them quite enough time. I don't think the Fed can hold up $1 trillion worth of time of Treasury bills selling from Japan
yeah,
until they're forced to pivot. You understand my point?
yeah. Here I've got the dollar yen chart, and so people can see what he means here. Right now we're like at 150 almost, but it has been down here, down around 80. And this is
Exactly.
when the Japanese Abenomics started, and Kuroda, he's retired now, but he started going crazy, and now with bond yields going up, and the dollar, U.S. interest rates going up, that's why the yen is weakened. So what Andre is saying, if the Fed pivots, this could drop massively, which means the dollar would drop and the yen would go up.
Yes, if the Fed starts printing, that's
Yeah,
a likely scenario, in my opinion.
yeah. So what else have we got? Yeah, could you explain to the viewers about, I mean, I have a playlist about counterparty risk. Could you
Mhm.
explain to them what that really is? Because some people might not be familiar with it.
Well, counterparty risk basically is when within a certain ecosystem, let's say the banking system, banks don't want to lend to each other because they're afraid of not getting their money back. Put simply, that's how it works. What might trigger that? Uh, Hard to tell. Back in '08, at one point, the market stopped because Bear Stearns was being loudmouth. Then came Lehman Brothers, and the Fed had to interfere. So counterparty risk, as it becomes an issue, uh, I don't know. I'm trying to think about an example that would apply to
Yeah,
today.
I guess in 2019 as well, when the repo market went crazy, repo market that was counter people didn't want to borrow or lend from other people, right?
Mhm. You see, this year we had the SBB Bank episode. That was counterparty risk. They were losing deposits. People were downloading their apps to take their money out. Word came out. Somebody tried to warn people. I don't remember who that was, but it was someone from San Francisco warning people about their money. And the Fed had to step in. And at the time, they decided to put the bank for sale and kick the can down the road. I'd say Credit Suisse is yet another
Yeah.
example.
Yeah.
Uh, for the Fed to pivot, in my opinion, one of the big ones will have to have this kind of problem, and
Yeah.
it's coming. It's going to be
JP
a
Morgan, did you see Jamie Dimon said he's going to sell some shares for the first time? And I think JP Morgan dropped 3.6%.
well. Maybe he's buying some gold, Mario. I would
Yeah.
if I were him.
And you think maybe JP Morgan is looking to buy some regional banks as well?
Well, look, JP Morgan is on standby to do whatever it takes to help the Fed keep the banking system functioning. As far as absorbing smaller regional banks, I think it's a done deal. What worries me a little bit, Mario, about those regional banks, because they're bound to be in trouble before the big ones.
Yeah.
Probably, not certainly, but probably. But what worries me about that, Mario, is as I see the big banks, the only one that is in fair enough shape to buy these regional banks is JP Morgan. I look at Citi, I don't see how can they absorb regional banks, nor Wells Fargo, let alone Bank of America, unless they get a very sweet deal from Jerome Powell, which, by the way, JP Morgan did. So, I mean, I remember I posted when JP Morgan absorbed these Silicon Valley banks, uh, they required the Fed to give them an 80% cushion on loan loss reserves from these banks' assets. So it's almost as if JP Morgan got it for peanuts.
Mm.
So these are, I'd say, these are hidden benefits that the Fed has given to banks to keep the system going without calling it the QE, without admitting, the runway is getting shorter.
Yeah, they also implemented that BTFP. Do you think
Yeah.
that do you think that's helping a lot? Because just by people knowing that it's there, they're a bit calmer about the banks.
Well, if you stop and think about it, the BTFP allows the banks not to book losses in their US Treasury holdings. And I guess the BTFP also includes, Mario, some quasi government mortgage backed securities of sorts. Okay. Whether or not this BTFP is also protecting the banks from other stuff. If that is the case, it is still their best kept secret, because you can put anything you want under this program, and maybe doing so without telling the populace.
Yeah.
I often think about that, but trying to evolve into what you asked me, the markets are reactive. Once there's the BTFP facility where, investors look at banks and say, well, losses in bonds for banks no longer an issue. They tick that box and they move on. And then they keep watching employment, inflation, GDP, all sorts of economic indicators, looking for a hard landing, a soft landing, a Fed pivot of sorts. That being said, it's been quite a while since they installed the BTFP. It's going to expire within, I think, in March or April. It's most likely it will be renewed into infinity, in my opinion. But there's other stuff out there, Mario, besides the US Treasury bonds that are going to cause a lot of pain to the bank's balance sheets. And if you look at the recent indicators for the banking system, I think the market is starting to smell that, it's about to come back. You can see that, the banking indicator is now as low as what it was back when they installed the BTFP. One thing that called my attention, Mario, was Jerome Powell's latest public statement. He said a couple of things that, if you put them together, it's quite worrisome. First, he said that he doesn't think bond yields were going up because of a strong economy. And then he said he knew that the fiscal numbers for the US were not sustainable. You put two and two together, Mario. What I understood from those statements is it's over.
Yeah,
We
and
lost.
Yellen the other day said, no, she said the opposite. She said the yields are higher because the economy is doing well.
Well, she's a laughing stock, huh?
Yeah, yeah.
Yellen has become a meme. She's a walking, talking meme, as far as I know. But going back to Jerome Powell, if he admits he lost control of the yield curve, and he admits that the fiscal situation is unsustainable, there's nothing else you need to hear. So I anticipate that there might be a Fed pivot when we see cracks in the banking system. It might be horrible if such Fed pivot happens in the face of still high inflation, high oil prices, high food prices, and all sorts of geopolitical problems on a global scale. And the other side of this scenario would be he keeps rates high enough, long enough to tear it all down. I would guess that the Biden White House, as rates remain high and higher for longer, I would say, Mario, they're going to boost those deficits quite a bit to compensate.
And
they don't want a recession.
Could they
You
sack?
understand my point?
Yeah, could they sack Jay Powell?
I don't think so. Here's the thing: there are many conspiracy theories out there, because they say Jay Powell, the Fed is owned by the banks.
Yeah.
The U.S. Fed is a private corporation. The European Central Bank is not. So, for example, when the European Central Bank talks about CBDCs, which is, in my opinion, a death blow to the European banking system, is going to remove a lot of businesses from the banks. Once you install the CBDCs, the banks are going to lose a lot of businesses. But when you talk about CBDCs in the US, it's a different story because the Fed and the banks are one. The Fed belongs, it's owned by the banks. Why am I saying this? Is I have a hunch that Jerome Powell tricked Biden into reinstating him when he was still playing ball because inflation was not a thing at the time. So he printed all the money in the world. He lowered rates so COVID could be, the economic side effects from COVID could be avoided. But now that the system is on the verge of being reset, I think some bankers, the likes of Diamond, call them up and say, we're not going to go for this. We're not going to go down and endorse our business to the central government under the guise of a CBDC. So that's why I think Jerome Powell and Yellen are not on the same page.
So
They
you
were
think Jamie Dimon and the private, they don't want a CBDC because it would.
It would damage their business model.
Yeah.
A CBD, for you to have a CBDC, I think you might end up with maybe a handful of US banks.
And there's 3,500 now.
I think it's about 3,500 banks in the
35?
US.
Okay. Yeah, maybe.
So you would have to end up with a handful of banks and CBDCs together with blockchain technology and all sorts of smart contracts and all. That would redesign, that would cause a revolution to the bank's business models.
Yeah.
It's a big change. There might be some winners, a ton of losers. I don't think the banks in the US, they want that.
Yeah.
I think they rather reset the system and live another day. And what I mean by reset the system, Mario, they would expect Powell to raise as much as needed to suck up all the dollars in the world, cause a tremendous dollar squeeze, which emerging markets are already feeling the pain. You look at Turkey, you look at Argentina, look at all sorts of, Bangladesh, Lebanon.
Nigeria, I saw Nigeria as well
That's
now.
That's the Powell dollar squeeze so far.
So could we maybe also talk a little bit about BRICS, because you're in Brazil. I mean, we talk a lot about BRICS, but we're not in Brazil, Russia, India, or China. You as a Brazilian, do you think the BRICS are really that important and that they will challenge the dollar?
I hear a lot about the BRICS being somewhat overrated, but I don't think they're that naive, Mario. And let me explain. They have to try and tackle one problem at a time. So BRICS is not about global domination. BRICS is about some very urgent problems that need to be solved now. There's a tremendous amount of geopolitical conflict on a global scale. You see, Russia was kicked off SWIFT. There's a battle for oil going on. I posted something, I think it was yesterday. If you think about it, the oil for dollars that took place after the end of the gold standard has allowed the US to print at will, knowing that there is a permanent demand for dollars. And guess what this money that can be printed at will funds? The US military. And the US military, funded by printed dollars, makes sure at gunpoint that every oil producing country in the world invoices their dollars, their oil in dollars. Then all of a sudden, this arrangement is being put in check. I guess what's going on in Russia, Ukraine, China, Taiwan, in the Middle East, they believe that they can break these chains. And what scares me a lot, and I will get to the BRICS in a minute, what scares me a lot is that once you consider that dollar for oil is an existential threat to the United States, namely to the US military industrial complex. I mean, the incentives are there for them to go all in and enforce oil for dollars. Going back to the BRICS, the urgent issues that need to be solved, which are being solved, is they have their own SWIFT system. I forgot the name, Ariel. They have their own SWIFT system.
Is it the chips or China?
No,
there's a Russian one as well, isn't
it's a no. It's they have their own SWIFT system that is already working, and it's working well.
it?
And I think there's maybe 120 countries that already are plugged into that system. And that is to avoid sanctions from the US going forward, because, you know, just look at what's going on in the Middle East. You need to have an alternative to SWIFT. That's the first problem they need to solve. The second problem they need to solve is, unlike, you know, the good old days, say when I mentioned the Swiss franc and the dollar as having a 7% per annum inflation rate, these countries are not good with money, to say the least. So what they're trying to do, Mario, is build within themselves an ecosystem. No one knows how far this is going to go, when and if it will break, but what they need is something that they can work with outside the dollar. So the ecosystem, basically, as I see it, is you have a physical gold market in China. You've seen a premium between gold in China and gold in the CME for quite some time now, because the gold is going from the West to China, because it's more expensive in China, because China wants gold to back the currency for them to trade amongst themselves. That being said, China is gone a step further, because if you think about it, Chinese people have always saved in real estate. They don't have too many options. They cannot buy anything outside China. So real estate has been a big chunk, maybe 70% of the Chinese savings. And that has imploded thanks to the dollar squeeze, I might say. So what they're saying is they're resetting the Chinese population into having gold bank accounts, physical. So this is amazing, because look, Mario, think about a Chinese worker. He wants to save. So he's no longer buying an apartment, 2 or 3. He's buying gold kept at the banks. He never touches that gold. But guess what? This gold can be financialized by the Central Bank of China. So now China not only have access to as much gold as they can produce and as much gold as they can buy in the international markets, but they can also access the gold that their population can acquire attached to their bank accounts. And that's a whole lot of gold.
Yeah.
And with that whole lot of gold, they have a physical market in Shanghai, where, for example, Iran might send X million barrels of oil, and they may pay them a new one backed by gold. And theoretically, Iran could retrieve physical gold and take it.
Yeah, they can use the Shanghai Gold Exchange. You can sell the yuan for the gold and take it.
Mario, this is not theory. This is happening.
Oh yeah, I know.
This
Yeah,
is
yeah.
functional.
Yeah.
That being said, there are many ways they can try also to avoid the dollar. For example, think about African countries. They have gold, so they can use gold to buy from China. But China can also build infrastructure projects in these countries in exchange for oil, minerals, rare earths, all sorts of things. And that is what is driving the United States up the walls.
And what
Because
about
like
Brazil? Because Brazilian, I mean, I haven't lived there for a long time, but I still think Brazilians still favor the dollar and the US a lot. Is there like what's the support for this BRICS mechanism in Brazil? Do you think it's gonna catch on or?
that's an interesting question. Brazil is not your no longer your typical emerging market. I think I sent you a message about how I see Brazil. Brazil is an export powerhouse. It has a lot of commodities, iron ore, food stuff. Brazilian economy is not growing as we speak. It is more the public sector that is growing. So there's less imports, more exports. So Brazilian trade balance is quite positive. And Brazil has something that no one has. Brazil sits on $340 billion in reserves. And the public sector liabilities in dollars here in Brazil, Mario, is less than 100 billion. So for any reason, if the dollar were to go to 10, Brazil net debt to GDP would be zero, because dollar appreciation would cause a profit for Brazil's balance sheet. Think about Argentina being the opposite, the extreme opposite. So with that said, Brazil becomes less passionate about these things. I think Lula, well, how should I put it? It appears that the Brazilian government is well aligned with Russia and China. They want to use the BRICS mechanism to free themselves from, not from the dollar, but from dollar dominance.
Yeah,
They
because
need to have
they still,
alternatives.
I mean, Brazil will still deal with the US in dollars, and but they want to be able to deal with other countries in their own currency, I guess.
That's exactly the point. If you think about diplomacy, uh, you want to deal with everyone. You don't have to deal with someone in detriment to someone else. So this is what Brazil would like to keep. Brazil would like to trade in dollars with the United States, but Brazil would like to be allowed to trade in gold-backed yuan with China, for example. The problem that I mentioned earlier, Mario, since I understand that this de-dollarization is an existential threat to the United States because they can no longer fund their U.S. military industrial complex, hence they cannot no longer rule the world. I don't think they will allow anyone to have these diversification of sorts, where you can trade with China and Russia, say in something backed by gold, or some kind of barter between fertilizers and food stuff, all sorts of things that they're trying to build in this BRICS Plus arrangement. So I don't know.
So
We have to see how.
do you think this latest crisis in the Middle East is part of this, that they want to disrupt the whole region and break up the BRICS, maybe? Is that the US? Yeah.
100%. I think 100%. I think I think the main objective of the U.S. is not even what's going on in Gaza. I think what they need is that they want to force Iran into a misstep, as much as they try to force Putin in a misstep, which didn't happen, so they can have the excuse to go to war and restore their bond market, restore oil for gold, and protect U.S. hegemony, which doesn't make any sense, Mario.
Yeah.
It doesn't make any sense.
I
The
mean,
U.S.
it
has
favors the military industrial complex and the elite, but the American people, I mean, I
but
think the best thing to happen would be for the dollar
yeah,
to
and
go
it and if
away.
you stop Yeah, and that is even worse when you stop and think about the fact that unlike Western Europe, United States is rich in resources, all of them. They have oil, they have everything.
Yeah,
And they wouldn't need to destroy the world.
I
You
know.
know, if you
Apparently,
think
there's
about it,
like 300 years worth of oil in the north slope of Alaska or something.
they're going to enjoy some kind of Pyrrho victory, if I may say. You understand my point?
A Pyrrhic victory. Yeah.
Pyrrhic,
Yeah.
where you win but you lose.
Yeah. Yeah. Yeah.
You know, they're on the verge of destroying the world to save something that doesn't need to be saved.
Yeah. And I think it's, if you look at the fiat dollar or the petrodollar, ever since they went off gold, the US has been living beyond its means. All the trade deficit, current account deficits, and they've been able to destroy industry and financialize. I think it would be in the long term a lot better for the average American to go back to a system that's more like diplomatic, like you said. You cooperate with everyone, but
Yeah, but if I may, Mario, you get what you deserve. What the US thought of doing was to bring China to the world commerce stage. They found they gave them a market for their manufacturing goods, and they got China to buy their treasury bonds. And that put them in a big comfort zone. China used this arrangement quite well. They became a technological powerhouse, an economic powerhouse, a military powerhouse. And the thought of China teaming up with the richest commodity powerhouse in the world, Russia, it blows their minds.
yeah,
You understand what's
it's backfired. They thought they could keep control of China, but now it's like,
no? I was trying to highlight what you said about US living beyond their means. China allowed them to do that on steroids.
well,
You understand my point?
so did the Saudis and all the oil producers as well to some extent.
Yeah, but China blew it out of the water.
Even more, yeah,
Yeah.
yeah.
You know, a simple example of that is what happened in Europe. Uh, Western Europe started to become uncomfortable with the fact that Germany, the biggest industrial export uh, in Europe, had a partnership with Russia, cheap oil in perpetuity. So they caused this whole, this whole mess because France thinks that Germany might be a problem if they have cheap energy and this superior industrial capacity. The UK thought the same thing, and here we are. They got what they wished for. Germany has been deindustrialized, and Europe has no hard assets. Europe can no longer live off debt and fake carbon credits. I don't know what's going to happen this winter. I see natural gas prices going through the roof as we speak.
Are they
So
going
we'll
up?
see.
I haven't followed them. I have to keep.
Yeah, if you look it up, they're on an
Yeah.
uptrend, a very strong uptrend. We'll see.
Yeah. And so we've got about 3 more minutes. Just want to see if people have any questions. So do you mind staying for another 10 so we can get
Uh,
some questions?
I'm
Yeah.
really enjoying this, Mario.
Yeah, me too. And I think it's good speaking with you. You have some really good perspectives. So yeah, if you guys have any questions, feel free to ask. We'll answer your questions now. Just have to wait. Rudy, come here, boy. Come here. He's come under my desk. Hold on. There you go. There you go. uh, he says, someone said, great interview. This is an awesome show. Yeah, if you have any questions, guys, feel free to ask. UK has North Sea oil. Could the banks reset fixed rate loans to floating rate? What do you think?
Well, I guess this is going to be dictated by the market.
Yeah,
I
I
mean,
don't
the
think
banks,
right now I would want to reset to floating rate because rates are going up.
you know, if you stop and look at the big boys, as of recently, one decided to cut short its short bonds position. So
Oh
where
yeah,
these rate
Ackman, wasn't it?
statement, yeah.
Yeah.
So it's funny because rates can go anywhere. Like I said, Mario, you have a scary enough event,
Yeah.
rates might go down on a flight to quality, but it's going to have to be very scary, in my
Yeah.
opinion. Well, you can also have a Fed pivot in the face of some kind of crack in the financial system, and you can have runaway inflation, and then the Fed might have to resort to some kind of curbing rate rights, rate hikes uh, by forcing people into holding treasuries. I think that's basically it. I
Yeah.
mean, I cannot
Yeah.
I can only guess what they're going to have to do. I think there will be more reactive than
Yeah.
anything.
Someone's asking why the M2 is going down on the US debt clock. I think it's because the Fed is basically destroying money when
Yeah, exactly.
they've taken the trillion out of their balance sheet. So
And Yellen is doing the opposite.
yeah, it's crazy. Yeah. Let's see if any more questions. Uh oh yeah. Ask Andre his thoughts on silver.
Well, I might get some hate about this, Mario.
That's all right.
Let's do it. I think people have a wrong concept about silver because way back in history, silver was money, and people like to say, I read a lot about people saying that gold is rich man's money and silver is poor man's money. But if you fast forward to today, Mario, I even had a conversation. I even discussed this with Clive Thompson the other day, and I think he proved my point. I think the inflation rate for silver is 30% now. And silver usage in industry is quite wide, a lot wider than gold. So if you stop and think about silver as a protection against monetary debasement, I'm not going to say it's not going to work under a hyperinflationary scenario. I just don't think the United States can afford hyperinflation. So they will do something bad to keep hyperinflation at bay at the expense of the taxpayer. True enough. But that being said, if you think about a metal that is not so scarce, that has a tremendous amount of usage in the industrial in industry, uh, I don't think silver has the potential to earn monetary value as much as gold. I think silver will eventually converge, like every single asset, it will eventually converge to its cost of production.
Mm,
And of course, its industrial demand. Whereas I see gold differently. I think gold uh, can have its price discovery not just based on its cost of production. It's a lot scarcer than silver. I'd say gold's inflation rate is about 3% per annum. And gold doesn't have a lot of usage in industry. Gold has a lot of demand in jewelry, in store of value, and demand from the central banks.
yeah.
The problem with the central banks, Mario, and I might be going out on a limb here, is that central banks do a very, they have a big influence in the price of gold because they don't buy it in the open market now.
Mm,
They buy it in over-the-counter transactions, large over-the-counter transactions. I do believe that BRICS Plus will reinsert gold into the financial system. I do believe, I'm not sure how this is going to end, because theoretically you could go to Shanghai and retrieve your physical gold. I think eventually you might have a perfect storm on gold, where money printing is going to go mad. BRICS are going to trade in gold. Chinese people are allowed to buy physical gold, and people are going to wake up and they're going to run for protection in gold. You understand the difference I see between gold and silver? I
Yeah,
think
I
gold
just think
gold
that
might,
some people don't think there's that much gold produced, like 30% inflation
silver.
a
Yeah,
year. Yes,
yeah.
silver.
I might be wrong. I'm going to
Yeah,
revisit my conversation
yeah,
with Clyde
yeah,
Thompson, but I was under the impression that silver's inflation rate is quite high.
yeah. I
I've
think
I've
if
read it
you,
somewhere.
yeah,
I
if
might
you
be
add,
wrong, Mario.
if the thing is, if you add all the silver that's above ground that you could recycle, it could be 30%. But there's a Chinese guy who looks into that, and he said that with the prices now, sometimes it's not even worthwhile recycling it, but it doesn't matter. Everyone has
But think about
their
it.
opinion.
If you think about it, Mario, let's say silver goes up to $60. It can be inflated a lot easier than gold.
Oh yeah, it will. It could. But what I'm saying right now at 23, I don't. Yeah, we'll
What
see.
I'm trying to say is, I'd rather hold less ounces of gold
Yeah,
and more ounces of silver.
no, that's fine. And
That's fair.
yeah,
It's personal. I mean,
that's why there's a market. People,
mhm.
just one final question. Someone asked, and this is more political, because it doesn't seem to have mattered too much. What do you think of is Lula like just as divisive as Biden, or other or Trump? I seem to get that feeling. I don't follow too much what's going on in Brazil, but I have a few people
Well,
on Instagram, and I can see that anything he does, they criticize. So what's going on there in that?
well, it's very hard for me to tell exactly how I see Lula out in the public, but I'll do my best. I don't think I think he's very divisive. I think if you think about the circumstances under which Joe Biden was elected, Lula was pretty much under the same circumstances. Lula, as much as Joe Biden, they cannot walk the street, and jump to your own conclusions when I say that.
Yeah,
And
yeah,
he's a communist. He wants the
yeah,
government to become the entire economy.
yeah,
He wants to have a handful of large corporations under the guise of the public sector, and that's it.
mm,
Which he tried and failed a couple of times under his guise and then under Dilma.
yeah,
Uh, Brazil Brazil is still has some checks and balances, keeping Lula from converting Brazil into Argentina of sorts. But we shall see.
yeah.
I hope I answered the question
No,
the
that's
best I
good. That's good. I was gonna ask something else. I forgot now, but hold on. What is it? I guess it can't be that important. Uh,
can.
but anyway, it was really nice speaking with you. And if you want, I think people enjoyed having you on. We could come on
That's good to
again.
know. I
Yeah.
would love to, Mario. I'm
Yeah.
one of your biggest fans.
Well,
Just
thank
so
you.
the audience knows, I really am.
How long have you been
And,
watching my
for quite
channel?
some time. I don't
Oh,
know
all
out of
right.
my head, but I've been watching you for quite some time. And one thing that I like about your platform, uh, I think you're a one of a kind, Mario. I think you bring in some. Uh, you're humble. You bring in some information from primary sources. So you often mention books. You often mention history, which is what people need to know to understand what's going on.
Right.
People are not going to learn from what's on CNN or those fast flash
Fast money.
information.
Yeah.
Exactly.
Yes.
So one thing that I enjoy about your persona and your content is that there's this magical mix between you as a good person, as someone who I would like to have as a role model. I think about your trajectory. You and Rudy once you once in a while talk about your routine with Rudy. Rudy was getting trained. He was getting
Yeah.
prizes. You talk about your golf trips, and then you come up in the morning here in London, and you have all sorts of nice info to share. And it's kind of like it's a breath of fresh air amongst what's out there. So I have to tell you, every morning I turn on my smart TV before I go to the gym to watch you because it gives me peace of mind.
Thank you. Thank you.
Am I honest? I mean it.
Yeah. No, that's nice to hear. And yeah, it's nice to meet you and
Like,
talk with you, and we'll keep in touch.
I hope so, Mario. Hope to be back soon.
Sure. Yeah. Take care.
You too. Bye bye.
Eu tô acabando o stream aqui. Ok.